about an annuity like a piggy bank. It's something to put savings into. So you as the owner would pay into your annuity, and then it's going to grow depending upon what kind of an annuity is, either by an interest rate or by the performance of some separate accounts. Then, when you want to start taking an income from the annuity, you annuitize it, you turn on that income stream, and the annuity starts paying you an income. Annuity basics. Think of an annuity as a piggy bank. It's something that you're going to save by using it. So you as the owner are going to pay into your annuity, and if you decide to take money out in the future, then your annuity will start paying you. Annuity periods. There are basically two different phases or parts to an annuity. The first part, when you, the owner, is putting money into the annuity, is referred to as the accumulation period because you're accumulating or gathering savings for the future. The second phase is called the annuitization phase. That's when you stop paying money into the annuity and you decide to turn on an income stream and pay yourself from that annuity. That's the annuitization phase. Some additional information about annuities is to remind you of the two different parts or phases to an annuity. You have the accumulation period. That's where you put money in and it grows for you. You're not taking money out, you're putting money in, you're accumulating. Then, if you decide to annuitize, because you never have to, but if you decide to annuitize, it means you decide to stop paying money into the annuity and you start taking an income from the annuity. That's the annuitization period. There are several different ways that you can put money into your annuity. Let's talk first about a single premium. You have a large sum of money. For example, maybe you're the beneficiary from someone's life insurance policy and you have a large dollar amount of money. You could take that large lump sum, single payment, put it into your annuity, and then it would sit there and grow inside the annuity and until you need it, if you ever decide to take it. Another way is to do flexible premiums. You can kind of pick and choose. Maybe you get a bonus and you put some money in. Maybe you put $100 in every month, or you skip a few months, or it's totally flexible. You get to choose. So you have a lot of choices and you can customize that annuity to best meet your needs. When income payments begin with an immediate annuity, when you take a large single premium, a lump sum of money, and you put it into an annuity, and you decide that I don't want to let it sit here and continue to grow, I need to start income right away, then you create an immediate annuity. The immediate means you immediately go from the accumulation phase to the annuitization phase where you start taking income out. Usually the payments begin somewhere within the first year after putting that large lump sum in. That's an immediate annuity. Another way you can do payments out of an annuity is called a deferred annuity. So you put in a lump sum or you put in periodic flexible payments, whatever, either way, but you don't take money out right away. You're putting money in either one time, large dollar amount, or multiple times throughout the course of maybe many, many years. And you defer or you don't take right away an annuity payout. Now remember, do you ever have to annuitize? No. But down the road, let's say you decide maybe you retire and now you want to supplement your retirement income. So you would annuitize your annuity. You would turn on that income stream. You would stop paying money in and it would start paying you money out of the annuity. How many people can own an annuity? You can have a single owner, which is, not uncommon at all. In fact, it's very typical. Or you could have multiple lives. Then it's called joint or joint and survivor annuity. You're covering more than one person with one annuity. fixed versus variable annuities. So there's two different types or versions, if you will, of an annuity. You can choose a fixed annuity, which uses a stated interest rate to grow the money that you're putting into the annuity. The insurance company says, we're going to give you a 6% interest rate, meaning all the money that you put in is going to grow at a 6% rate. You know exactly what you're going to have. Or you could choose a variable product, which uses those separate accounts, those underlying investments that are securities. So this is the annuity that you have to have a life insurance license and a securities registration to sell, because you have stock market exposure through those underlying investments. Fixed versus variable annuities. Let's look at some of the features. If you have a stated interest rate, that's always a fixed annuity. It's guaranteed. If the income payments are guaranteed, that's going to be from a fixed annuity as well, because they can tell you exactly what it's going to be because they know the interest rate, so it's all good to go. If you have a variable annuity, there is no interest rate. Your investment grows based on the performance of those separate accounts or those underlying investments. They have exposure to the stock market. They're like mutual funds. So the market varies every day. The value of your annuity could value every day as well. So the income payment would also vary. Now the premiums that you invest, the dollars you put in, if it's a fixed annuity, the monies go into the insurance company's general account. They do the investing in order to be successful enough to meet that guaranteed interest rate that they promised you. On the variable, your monies go into the separate account and you choose what mutual funds to put them in. The licensing required on a fixed annuity, remember it's an insurance product, so you need an insurance license. But if you're selling a variable, you have to have that insurance license, but you also have to have a securities registration before you can sell them. There's several things that you can do or accomplish by using an annuity. You could put monies in from a lump sum settlement. Oftentimes, people that have some type of settlement, maybe from a lawsuit, they might put a large dollar amount into an annuity to grow, and then if they need income, they can turn it on at any time. You can use it in qualified retirement plans. A lot of people choose annuities. They're a very popular choice of investment tool. Retirement income. Of course, if you have an annuity, say you've been paying into it for years, or you take your retirement money from your pension plan maybe, and you buy an annuity with that lump sum, you could then annuitize and create retirement income for you to supplement that Social Security check that's going to come to you. Also, you can use it if you need to for educational funds. There are lots of things that you can use it for. They're very popular. The deferred taxation is an important feature. Many people use them as a retirement planning tool. The suitability of whether a client or not should purchase an annuity, very, very important. You must really get to know the client and ask the right questions, because number one, annuities are not short-term investments. They're considered long-term investments. So if a client says, yeah, I've got this money, but I'm going to need it in cash in like 18 months, you certainly would not want to put them into an annuity because they could have surrender charges for taking the money out too soon. So you have to ask the right questions. You have to find out what exactly is their financial situation, what's their tax status, investment objectives. What are they trying to accomplish with the money that they have? What's their risk tolerance? Of course, a fixed annuity is more secure. A variable annuity is riskier because of the market exposure. And there's any other information that they can give you. Like, for example, they're going to need this money in a short period of time. That's a dead giveaway that you do not want to place them into an annuity because they would probably have surrender charges when they took money out if they take it out too soon. So again, ask those probing questions so you match the client to the right product. Qualified plan requirements. First of all, qualified plans need to meet the requirements of the IRS. They are exclusively for employees and their beneficiaries. They are formally written and communicated. In fact, most of them have third-party administrators. There are complicated issues sometimes that have to be dealt with. They even have to file their own tax returns. So they're not for everybody, but they certainly are important for those who have them. One of the things that the IRS says, you must not discriminate. You must cover all of your employees who meet the eligibility requirements. They're permanent, meaning that they are going to stay in place. They should not be entered into lightly. They're meant to help these people be prepared for their retirement. And they must also have a vesting requirement. And the vesting means ownership. And it means the ownership of the monies put into any qualified plan by the employer. Sometimes they'll have immediate vesting. Sometimes it'll be different. You wait a couple of years and you have no vesting, and then after a certain point you go from 0 to 100%. Or they might have a graded where you gradually build up the ownership of the employer money. So the longer you stay with the employer, the more of the employer money you would receive should you leave. Qualified versus non-qualified plans. Qualified plans have strict participation guidelines. Like, for example, you have to cover all eligible employees. Usually that means full-time, worked for you for X amount of time, be a certain age, things like that. Discrimination is prohibited, meaning that all eligible employees have to be covered. Employer contributions, the employer gets to deduct as a business expense anything that they pay into a qualified plan on the employee behalf. And employee benefits are going to be taxable to the employee when they take those benefits, usually at retirement time. A non-qualified plan means it doesn't have to follow the ERISA guidelines defined by the IRS. No guidelines to follow. They can discriminate, and oftentimes non-qualified plans only help to take care of the highly compensated, usually management level type employees. The business cannot deduct on the taxes anything that they contribute in these plans on behalf of an employee, and the benefits are taxable to the employee. Traditional and Roth IRAs. First thing you have to prove is earned income. Then you have to figure out about what contributions you can make. First of all, they're going to be pre-tax, which is a nice help to you at the time you make them. You are going to have limits. It's going to be based on how much money you make and whether you're covered at work by a qualified plan or not. Also, they may be deductible on your tax return, but again, it's going to depend how much money you make and what kind of plans you might be taking advantage of at your employer. Now, with withdrawals, you don't want to take money out of an IRA before age 59 and a half, or you're going to have that 10% IRS penalty for early withdrawal. You do have to start taking required minimum distributions at 70 and a half. That is a very important point to remember about a traditional IRA. Roth IRAs. One of the things you must prove in order to take out a Roth is you have to have earned income. Then let's talk about contributions. Contributions into a Roth go in after tax, meaning you've already paid tax on that money. So you can also continue to make contributions after age 70 and a half. It's different from a traditional IRA in that respect also. You do not have to take out money starting at age 70 and a half. There are limits. And at some point with Roth IRAs, if you make too much money, you're not able to contribute at all. So there's some differences and similarities between a traditional and a Roth. Now, withdrawals, again, no 70 and a half rule. So you could leave the money in and never take the money out if you don't need it. And if you take out what you put in, remember your contributions, you paid those in, they're after tax. You can take that money out of a Roth at any time, no tax, no penalty. You've already paid the tax on it. So it's kind of like a big piggy bank. But if you take earnings out Earnings have always been deferred, so you're going to pay tax on any of those deferred earnings that you take out of a Roth. Retirement plans. Let's kind of compare and contrast some of these various retirement plans. You got an HR10 or KEO plan. Those are for self-employed individuals. You have a SEP, which is for self-employed and small employer. You have something called a simple plan, which is for small employers with 100 or less employees. You have a 401k. Any employer can put those into place. And you have a 403b, sometimes referred to as a TSA, a tax sheltered annuity. Those are typically for nonprofit type situations. So who can contribute to these? A KEO plan, an HR10 plan, the employer matches the employee's contributions. On a SEP, the employee and the employer can both contribute. On a simple, the employer matches the employee's contributions. On a 401k, the employer matches employees' contributions if they choose to. They're not mandated. It's up to the employer. And on 403b plans, it's employer and employee dollars that go in. Now, what are the limits on the contributions? Just be aware, those limits are established by the IRS and they are reviewed and altered annually. So January 1st every year, you always want to make sure you've got the new limit for all of the qualified plans for that year. Let's take a look at the tax treatment on permanent life insurance. What is not tax deductible? You as an individual cannot deduct the premiums that you pay on your personal policies, and you cannot deduct policy loans on your taxes. What is not taxable? Policy dividends and death benefits that are paid to named beneficiaries are never, ever taxable. They're federal income tax free. What is taxable? Any excess cash values and interest or dividends could be taxable to you. Taxation of deferred annuities. One of the features of annuities that is so popular is this tax deferral. As long as you are putting money in and the annuity is growing, you're going to have earnings on that over time. The taxes on those earnings accumulate, but you do not have to pay them when they're earned. They're deferred until you take them out of the annuity. So withdrawals, they're going to make you always take the gains out first because you've deferred the tax on those. So they want you to take that out first, so you have to pay tax on that. They follow the accounting principle of LIFO, last in, first out. Last into an annuity are the earnings, first things in are the contributions that you make. If you take money out too early, before 59 and a half, for example, you're going to have a 10% IRS penalty for early withdrawal. And if you take a cash surrender, whether it's partial or a full surrender of the annuity before 59 and a half, you are going to have that early withdrawal penalty, plus anything that you take out that is earnings is going to be taxable to you at your ordinary income rates. Taxation on traditional IRAs. Let's talk about the contributions first. Contributions made in cash, they're tax deductible, and any earnings on those are tax deferred. Now, when you take distributions, you take money out. Income is taxable in the year in which you receive it. So as soon as you take any of that deferred growth or those earnings out of an IRA, you are going to pay tax on that, and it's going to be based on your ordinary income rates, never capital gains. IRA early withdrawals. There are a couple of exceptions that the IRS makes where they won't penalize you that 10% penalty for early withdrawal before 59 and a half. For example, if you, the annuitant, were to become totally disabled and you needed to start taking money out and you're not 59 and a half, they would not penalize you for taking money out because you're totally disabled. If you have catastrophic medical expenses, they won't penalize you. If you're using the money for a down payment on a first home, but remember there is a limit of $10,000 on that. And if you are needing the money to continue your post-secondary education, they would allow you to take the money out early. But remember, if you start taking earnings out, that is going to be taxable, for sure. Let's talk about the types of perils. But before we do that, let me remind you, what is a peril? A peril is something that causes a loss, such as sickness or an accidental injury. There are major types of losses. For example, medical expenses, loss of income from disability, dental expense, or long-term care expense. The nature of health insurance contracts. Remember, all insurance are contracts. First of all, they're always going to be aleatory, meaning unequal exchange. Think of it this way. You make one premium payment on your health insurance. You have a major accident, you're hospitalized for days and days and days, lots of medical bills. Those expenses are going to be much higher than the dollar amount of that one premium that you made. But even if it was just one premium, they still contractually have to take care of you. So they are aleatory contracts. Also, they're personal between the insurer, the insurance company, and you, the insured, the person who is covered by the policy. They follow the doctrine of adhesion. Adhesion is take it or leave it, or you got to stick with it the way it is. For example, an insurance company writes the verbiage or the language of the contracts. So in court, they have to stick by what is written, even if the judge says, well, that isn't very clear, so we're going to rule in favor of the insured person. So adhesion, you have to take it or leave it because the insured doesn't get the ability to change the wording of a contract. They are unilateral contracts, meaning one-sided. And it's one-sided on the side of the insurance company. You could always not make a premium or cancel your policy, but as long as that premium is paid by you, the insurance company is contractually obligated to pay claims that are valid. And then conditional. Certain conditions have to be met before the contract features would come into play, such as on certain medical benefits. For example, you might have to go through a physical or something like that before you would even be issued the contract. So there are going to be various conditions. It's going to vary by type of policy and vary by insurance company. Let's talk about the process of issuing a policy. We start out first with field underwriting. That's you, the agent, and you're taking the application, gathering the information from the client. Did you know that your title is also field underwriter? You're the only person who represents the insurance company who actually sometimes sees the client. So it's a very important responsibility. Then you have the company underwriting. The completed application goes up to the underwriting department. There may be information requested from person's doctors and various other tests that might be required. So they use all of that information. Those are the various sources used for the underwriter to make a determination if the coverage would be offered or not. Then you look at the risk classification. The underwriting department will either accept or decline the application as it was turned in. And if they do accept it, they'll determine based on the insurability of the client, they'll determine the amount of proper premium in order to make certain that the insurance company's risk exposure is properly paid for. And then there's policy delivery. That's the last step. The agent or the company delivers the policy. Typically, they'll come to you as the field underwriter, and then you go back out to the client and deliver the policy. And if they had paid for the policy ahead of time and then you deliver it, you're going to have them fill out an additional piece of paperwork called a Statement of Continued Good Health. And that just means that the client is going to say, since I took this application, nothing major has happened to me. I haven't had any serious health issues or anything like that. And they sign it just to validate that they're still the person they were at the day they took out the original application. Common exclusions. Exclusions mean things that aren't covered. They are excluded from coverage. For example, war or military service. Understand that any personally owned policies that you have, if you are in the military or you get called up to active duty, personal policies do not cover if you are injured or you die as a result of an act of war. So you have to remember that. You want to make sure you tell your customers that it would be an excluded act. Typically, the military offers their personnel very inexpensive term insurance, for example, if you're going into harm's way. Self-inflicted injuries, if you try to injure yourself or even try to commit suicide and you're not successful, those kinds of self-inflicted injuries would not be covered. Elective cosmetic surgery, never covered. Give you an example. You just want to have your teeth straightened just to look better. That's cosmetic. It wouldn't be covered. But say you had an automobile accident and your face impacted with the windshield and you have a lot of dental issues. You could have that covered because it is part of the repair of the injury caused to you in the accident. Conditions covered by government plans, like, for example, if you are in the military and you need, say, your appendix out or something like that, you'd be covered through the military. That's a government plan. Okay, so your sickness would be not covered by your personal policy. And then participation in criminal activities. Okay, so you're a bad guy. You go rob a bank. You get injured while you're robbing the bank. Don't think you're going to go to the emergency room and take out your insurance card and try to have your bills paid for that way. You were committing a criminal act, so that would be excluded from you being covered. Cost sharing. Couple of things here. Let's talk about deductible first. And speaking of first, that's what gets paid first. Always remember when you're reading through the material and you come upon deductibles. Deductibles are always your out-of-pocket that you have to pay first before the rest of the benefits within your policy will pay. It's usually a set dollar amount. Maybe it's a $50 deductible or a $250 deductible. So the cost of your medical care up to that, say, $50 amount has to be covered by you first. Then the insurance would be applied to the rest of the outstanding bill. And the larger the deductible, the lower the premiums. That's a concept. If you can remember this, it'll help you very much as you're going through the material. Think about this. If you have to pay a higher out-of-pocket first before the insurance company has to go on the hook to pay the claim, they're going to lower your premium for you being willing to accept a higher amount of money as a deductible. So it's a way to kind of control costs for you. Then there's something called co-insurance. Co-insurance, do not confuse it with co-pay. That's the dollar amount you pay, say, when you walk into your doctor's office and they say, oh, that'll be a $25 office visit. Co-pay. This, what we're talking about here, is co-insurance. Co-insurance is paid after you, the insured, meet your deductible on the plan, and then the insurer will pay a portion of that outstanding balance. It's usually a percentage, such as 80-20. That's one of the most typical. Always remember when you have these percentages, the first number, say, for example, the 80%, after you've paid your deductible, the insurance company will pay 80% of the outstanding bill, and you would pay 20% of the outstanding bill. And again, the larger the co-insurance percentage for the insured, again, it's going to lower your premium. The more that you have to pay over the insurance company paying, they're going to reduce your premium for that. Cost-saving services. First of all, let's talk about preventative care. Using annual physical exams, mammography, and other procedures to detect medical problems that are less expensive if you treat them early. HMOs, for example, they kind of pioneered the whole concept of this preventative care. They realized that if we can keep our people healthy or healthier, we're going to have less claims overall. So it was a radical new concept. Outpatient benefits. Using outpatient services, sometimes referred to as ambulatory, meaning you walk in, have a procedure, and walk out that same day. You have much less cost because you're not staying overnight in the hospital and having that 24-hour around-the-clock nursing care. You're not having room and board. So it's another way to help save the cost of the expense of the medical treatment. And then alternative care. That's mixing inexpensive alternative care techniques and costly care covered by the insurance plans, kind of mixing them together to still get you the proper kind of care, but not relying on just one thing or the other. It's a combination, again, to keep costs down.